Hi friends, Simit here from InformedTrades.com. In this video, I want to take a look at forecasting a crash in the S&P 500. The idea here is, there are some signs that the S&P 500 may be crashing, and this is, crashes constitute huge opportunities, because the idea is you're expecting a big move in a relatively short amount of time. So even if it's just an interesting opportunity, regardless of if you have a fundamental viewpoint. It's still an interesting opportunity to consider, and thus worth studying. Key points. When forecasting a crash, you want to look for technical signs of a large reversal. That's obviously the huge giveaway, or what should set off some interest. Also, even if you are bullish, this is an opportunity to hedge because the reward risk is so powerful. So personally, in the case of the S&P 500, I'm a little skeptical that it will have a big crash like we saw in 2008 and early 2009. I'm a little more bullish, but even if you have that mentality, there's still a hedging opportunity because because the odds of a crash are, again, it goes back to reward or risk, where there's that potential for such a huge reward. You can, put on a position, risk only a little bit, and so it's a useful way of sort of hedging a longer term bullish position, if that's what you have in mind. Okay, in terms of technical patterns to look for, maybe the first pattern that gets a lot of people interested in the idea of a potential crash is the Megaphone pattern. What you see on the chart here right now, this is a monthly chart of the S&P 500 going back to 1999. Megaphone pattern is characterized by higher highs and lower lows. So basically you see increasing volatility and greater ranges. Here on the monthly chart, we're coming up, we've reversed against that new high. We've had that new high and now we're starting to reverse. If the Megaphone pattern plays out, you're expecting a move all the way back down to below 700, the lows that we saw in 2009. So if you believe this, it's definitely, here's an example, there's a huge potential gain here, you don't have to risk much, so it's an interesting trade setup. The other catalyst is, there's a bunch of signs that gold is a precedent. The idea here is that gold gets sold to pay the bills, so whenever there's a liquidity crunch, if that's what you believe is occurring, the sell-off in gold could precede a larger sell-off in stocks. That's what we saw in 2008. Gold crashed, and then a few months later, the S&P 500 crashed. In 2011, again, we saw the same theme. Gold started falling, in the summer months, and the S&P crashed shortly thereafter. Here is a look at Canadian stocks, so this just reinforces the gold theme. Gold stocks have gotten hit incredibly hard over the past couple weeks, much harder than gold has gotten hit. But the other sectors in the Canadian stock market, and the same concept holds true in the U.S. stock market, have not gotten hit. So if the idea is that gold is a leading indicator, here's an opportunity to still short those other sectors. And this also shows how big, if it's a really pronounced move we saw in gold and gold stocks, which also reinforces the theme that a full crash could occur in a short amount of time, which that's like we mentioned at the outset of this video, it can be a great opportunity in that there's a big move in a short amount of time. So it offers a fantastic reward to risk setup, and obviously the opportunity to make quite a bit of money in a short amount of time. So that's basically the idea here, illustrating what to look for in a potential crash setup and how there may be one unfolding now in the S&P 500. If you have any questions, anything you want to share, join us at InformedTrades.com. Thanks and best of luck in your trading.